Something interesting is going on with REITs, and there's three things you need to know for this much hated asset class, namely the turn in technicals, the drivers of the turnaround, and remaining risks. So, starting with the technicals, as I pointed out there, the technicals are turning. We have seen a bullish divergence, so a higher low in the RSI versus a lower low on price, and this is a great predictor of turning points. We've also seen an inverted head and shoulders, which is an initial low followed by a lower low and then a higher low, and then ultimately, to confirm the pattern, a breakout. Again, this is also a good indicator of turning points, particularly at the end of drawn out trends like this. And REITs have also recaptured their 50-day moving average there, so they have broken out above it. So technically, it looks good. But what's driving this? Here's why REITs are rallying. Breadth was oversold, positioning or allocations to REITs were basically at record lows, and sentiment was extremely bearish. And I always say when sentiment gets like this, it represents a lot of minds that can be changed. We had also seen a significant reset in REIT valuations, which is the blue line on this chart here, and that was more so than commercial or residential, and typically this is what we usually see. REITs are the fastest to see a valuation adjustment, and also first to turn, being more liquid or hyperactive as you might call it. Lastly, a big driver of drawdowns, the previous drawdowns for REITs, has been the surge in bond yields, which has squeezed the dividend yield spread, which you can see on the chart of the left here. This has made REITs less attractive for income-oriented investors. So in that backdrop, it was just awaiting a catalyst, which has been delivered in the form of increasing belief that the Fed is done and that bond yields are headed lower. And on that note, US 10-year yields have already fallen more than 50 basis points in the past week or so. But what are the remaining risks? Aside from the technicals, and REITs still do need to actually overcome long-term resistance and their 200-day moving average, there are three things to consider. First, debt levels are still relatively high, so the red line here, almost twice the level of what we saw in the 1980s, and effective borrowing costs, so the blue line here, are turning higher for REITs. Second, while valuations have reset significantly, absolute valuations for REITs still remain elevated versus longer-term history, and that's true both for US REITs and global REITs. Third, the underlying of these assets, so commercial and residential property prices, are still trading at eye-watering levels versus history, and are at risk of a more meaningful downside adjustment if bond yields head higher again. Higher for longer risk is still lurking there in the background, and or if the economy rolls over into recession. So it's definitely a good setup for a trading rally, which we have already seen, and certainly some promise for REITs, but clearly not without some fundamental risks there. And so to sum up, REITs have turned the corner for now. This comes from a classic contrarian setup of extreme pessimism and valuation reset, but there are still notable risks to keep on top of in this space, even as things start to look brighter. So that's my view here. If you like this video, if what I've said made sense, then maybe you can hit the like button or give it a share, and maybe even head over to topdowncharts.com and check out what services we have to offer so you can access more analysis and insights like this.